Have you been studying candlestick patterns hard? Hammer, doji, long bullish candle. You've memorized all the names, but why do you keep losing money? It might sound a bit strange, but the more candlestick patterns someone memorizes, the more they lose. There is a reason for this. Candlesticks aren't meant to be memorized. They are meant to be read. What is the fastest way to read a person's mind? It's not their words, but their facial expressions. If they say they are fine, but their eyes are shifting and their face is dark, we quickly notice. Ah, that person is not okay right now. The market is exactly the same. Some days, the price keeps going up, but the candle hesitates, leaving a long tail wick. It says it's going up, but it lacks confidence. On other days, the price is tanking, but the candle is smiling with a long tail. We need to know how to read the market's facial expressions, because that is exactly where the market's true intentions are hidden. Today, I will teach you how to read the market's expressions, that is, the candlesticks. Please just give me 10 minutes of your focus. I will pass on exactly the eyes needed to interpret candlesticks. Most people learn candlestick patterns like this. This shape is a hammer. This shape is a doji. Memorize the names, buy when this shape appears, and sell when that shape appears. Just like memorizing math formulas. But what happens if you only memorize the formulas? You receive the test paper, but don't know where to apply this formula, because you don't know why this formula was created or when to use it. Candlesticks are the same. Unconditional upward movement just because of this shape. If you are lucky, you might be right once or twice. However, the market is not that simple. Even a slight variable makes it fall apart immediately. What is really important is why this shape appeared. It's the market psychology contained within it, and the flow of context before and after. Therefore, today we will not just memorize the shapes. We will start by understanding why this candle was formed and what psychology is hidden inside it. Then, the principles will become visible before the names and formulas. The candlesticks we will cover today are just three. First, the long bullish candle and the long bearish candle that appear when a trend continues strongly. Second, the doji, where buying and selling forces are tightly balanced. Third, the hammer and inverted hammer, which are signals of a trend reversal. If you know just these three things properly, you can apply them to most of the numerous candlestick patterns that appear in the market. Now, let's get started. Part 1. Basic Principles of Candlesticks. First, let's look at how a candle is made. A single candle contains 4 prices: the opening price, the highest price high, the lowest price low, and the final price, which is the closing price. Among these, the most important is the closing price. No matter how it started or how much it fluctuated in the middle, where it ultimately closed at the end of that time frame is the key. And what you need to pay attention to even more than the closing price is the tail wick. The tail is the trace of where the price went, the highest and the lowest. Where people bought and sold is all left right there. So, a single candle is the trace of the clash between buyers and sellers' minds during that time. And the collection of these traces of the mind is what creates a candlestick pattern. Let me point out one thing in advance. Candlestick patterns are less reliable on shorter time frames. This is because shorter time frames like 1-minute and 3-minute charts have too much meaningless fluctuation or noise. This is especially true for Bitcoin due to its high volatility. So, the method I recommend is this. First, look at the daily chart to see what kind of expression the market is making in the big picture today. Then, step down to the 1-hour or 4-hour chart to look into it in more detail. When you look at the large flow and the small flow together like this, the reliability of the exact same candle becomes much higher. Part 2. Long bullish and long bearish candles. Now, for the first candle. A candle with a long body and short tails. What does it mean for the body to be long? Think of a tug-of-war. It means one side overwhelmingly dragged the opponent along. These candles are called long bullish candles, and long bearish candles. Both are signals that strong force has entered the market. In particular, a long candle with almost no upper or lower tails means that everyone pushed hard in the same direction. So when a candle like this appears, it is highly likely that the trend will continue strongly in that direction. If you look at the trading volume alongside it, the reliability increases. If a long bullish candle appears with higher than usual trading volume, that upward movement has true power behind it. Put simply, a long body candle is a signal that the trend is continuing strongly in that direction. Part 3. Doji. The second candle is a cross-shaped, very small candle called a doji. A doji appears when buying and selling are tightly balanced. In soccer terms, it's like a 0-0 draw. Neither side could gain the upper hand, and they fought fiercely with similar strength. At times like this, it's difficult to judge which direction the market will go. Therefore, when a doji appears, it is wiser to wait and confirm the direction of the next candle or the one after that, rather than rushing in. You are watching to see how the expression of the market, which has not yet decided its direction, changes. In particular, a doji that appears at a high point peak or low point bottom is also a signal that a strong trend could be reversing. Put simply, when a doji appears, don't rush. Make your judgment after confirming the direction of the next candle. Part 4. Hammer and inverted hammer. The third is a candle where the tail is much longer than the body. It contains a signal that the trend is reversing, so it is the trickiest of the three. Even if it's the same shape, the meaning changes completely depending on where it appears. First, let's look at the candle with a long lower tail, the hammer. The lower tail is long, but the body is small, and there is almost no upper tail. What this means is that the price was pushed down strongly, but then bounced back up even stronger from a certain point. It hit the bottom, and buying pressure pushed it up. Therefore, if this hammer appears at the end of a downtrend, it becomes a powerful signal that the trend is changing. Conversely, a candle with a long upper tail is called an inverted hammer. The price shot up once, but was suppressed by selling pressure and came back down. If this appears at the peak of an uptrend, it is a signal that the direction could break downwards this time. The key here is location. Even with the same long tail, if it appears at the bottom, it's a bullish reversal, and if it appears at the top, it's a bearish reversal. So, don't just look at the shape, you must always look at where it appeared. If the trading volume also increased, the reversal signal is even more reliable. Put simply, location is key for long-tailed candles. A bullish reversal if it appears at the bottom, a bearish reversal if it appears at the peak. Part 5. Reading them together on a chart. Now, getting to this point, we haven't just memorized shapes. We have developed the eyes to read the psychology and flow contained within them. And one more thing. If candlesticks are the traces of the mind, trading volume is the voice that shows the market's true intentions. That's why candlesticks become much more accurate when read together with other factors like trading volume, support, and resistance. Now let's see how these three are actually read together on a chart. Example 1. The downtrend. First is the end of a downtrend where strong selling pressure has continued. Right at this point, a hammer candle with a long lower tail appeared. It's a signal that buying pressure pushed it up from the bottom. And next, two dojis appear. Buying and selling are tightly matched. As I mentioned earlier, don't rush in at a doji but confirm the direction of the next candle. Because the direction decided after this tug-of-war often heavily tilts to one side suddenly. Checking the direction, it has shifted to an uptrend, and immediately, a long bullish candle appears. All three patterns we learned have appeared in sequence: the hammer, the doji, and the long bullish candle. If you read these three candles in sequence, you can see that the market is changing direction at the bottom. The market, exhausted from the decline, has changed its expression. Put simply, if a hammer, doji, and long bullish candle appear in sequence at the bottom, it can be read as a bullish reversal. Example 2. The uptrend. This time, it's the opposite. A noticeable signal appears on a chart where an uptrend was continuing. It's an inverted hammer candle with a long upper tail. It went up, but its expression is somewhat uneasy. What kind of psychology is this? The price went up, but the selling pressure was stronger than the buying pressure, so it ultimately closed as a bearish candle with a long upper tail. The appearance of such a candle at a high point indicates the possibility of a full-fledged decline. The market says it's going up, but you have to watch carefully, matching that uneasy expression. Even if the flow has been rising well up to now, if this expression appears at a high point, it means the direction could take a turn for the worse. Put simply, a bearish candle with a long upper tail at a peak is a signal that the upward trend could break into a downward trend. Comprehensive summary. Here, we have gained one certainty. Candlesticks are the expressions of the market. If you know how to read the expressions, you can predict the next action to come. And based on those expressions, you can actually create a trading strategy of where to buy and where to sell. How to create that strategy will be covered in earnest in the next episode. If you properly understand the 3 candlesticks we looked at today, you can easily apply them to the complex patterns that appear in the market. Even if they look complex on the surface, if you take them apart one by one, they are ultimately just combinations of the candlesticks you learned today. The principles are exactly the same, so don't try to memorize the names like formulas. It is important to understand at what position and with what psychology this pattern was formed, because candlesticks are, after all, traces of human psychology. Lastly, I will tell you just one more thing. Actually, there is something more important than all these techniques. That is trading with your own unwavering investment principles. Techniques only exert their power on top of those principles. If you'd like to receive more chart analysis and trading insights, please join the free Telegram channel. The link is in the description. If today's video was helpful, please like and subscribe. I will see you in the next video with deeper discussions. Thank you.